They called me crazy when I said beginners could build a 20% plus yield portfolio from day one without insane volatility. They said it couldn't be done. But what if I told you that right now complete beginners are building portfolios that generate more passive income in a single month than most experts see in an entire quarter? Welcome to the ultimate beginner's guide to psycho investing. Today I'm going to break down exactly how to build what I call 40-20-30-10 psycho blueprint, a portfolio structure that delivers exceptional yields, daily income, and massive growth potential while letting you sleep at night. This isn't some theoretical strategy. This is a battle-tested approach that real investors are using right now to generate serious passive income while setting themselves up for exponential growth over time. Welcome to Psycho Investor, where we don't just chase yields, we hunt them down and make them our own. I'm not here to tell you about those safe 2% dividend stocks your financial advisor keeps pushing. I'm here to show you how anyone, even complete beginners, can build a portfolio designed to generate serious passive income from day one while setting the stage for potentially life-changing growth over time. But let me be clear, this isn't about gambling. This is about calculated aggression. Every component of the 40-20-30-10 psycho blueprint is carefully selected and positioned to maximize yield, minimize unnecessary volatility, and capture explosive growth opportunities. On this channel, we're all about building income machines that can potentially change our financial future. And today's blueprint might be the most important one I've ever shared, especially if you like the idea of getting paid daily while you sleep. Let's start with understanding what the 40-20-30-10 psycho blueprint actually is. Most beginners make one of two critical mistakes when they start income investing. First, playing it too safe with 2-3% dividend stocks and watching inflation eat their returns alive. Second, going too aggressive and pushing everything into high-yield positions that blow up their account on the first market correction. The psycho blueprint takes a completely different approach. We are strategically allocating 40% to non-volatile high-yield income generators, 20% to moderate yield income enhancers, 30% to option strategy yield accelerators, and 10% to leverage growth engines. Here's why this structure works so beautifully. The 40% non-volatile core does three crucial things: provides exceptional baseline income with virtually no price volatility, creates psychological stability so you can handle the volatility in your aggressive positions, and generates yields that most investors wouldn't believe possible from stable investments like 15-20%. The 20% moderate yield layer adds diversification with quality BDCs, REITs, and covered called ETFs in 8-12% yield range. The 30% option strategy accelerator layer gives us exposure to sophisticated yield-generating strategies, potentially yielding 15-40%. And finally, the 10% leverage growth engine is our rocket fuel for long-term wealth multiplication, all while maintaining a portfolio structure that lets you sleep at night. Let's start building this portfolio from the ground up, beginning with what makes this strategy truly psycho. The 40% non-volatile, high-yield core split equally between Ventus Energy and Indemo. This isn't your grandfather's stable income approach with boring 4-5% yields. We are looking for non-volatile income generators that delivers exceptional yields of 15-20% plus with virtually no price volatility, provide predictable secure income streams, have structures designed specifically for stable income generation. First, let's talk about Ventus Energy, a renewable energy project development company based in Baltics. Looking at the actual dashboard right here, you can see they are delivering me a 19.72% annual yield. But what makes Ventus truly special is their distribution frequency. These payments hit your account daily. That's right, you get paid every single day while you sleep. The business model is fascinating. As they explain, Ventus develops renewable energy projects in Baltic states focusing on sustainable energy development. They attract both senior and mezzanine debt for their project, with the mezzanine loans, the ones we're investing in, generating returns up to 20% annually. These aren't speculative investments. They are secured by real physical assets, property, and commercial pledges. as their financial structure shows. Now let's look at Indemo, our second core position focusing on discounted debts investments, DDIs. These are extraordinary instruments that provide exceptional yields without the daily price volatility of stocks or ETFs. Indemo specializes in discounted debt investments, particularly in the Spanish real estate market. They purchase loans at significant discounts where the borrower has fallen behind on payments. Since they are buying these loans at 30 to 50% discounts, when the underlying properties are sold at the market value, they generate enormous returns, often in the 15–17% range for the investors, us. As their platform explains, these DDIs are backed by bank-quality mortgages as a collateral, and almost all loans for secondary residences, making enforcement easier. The key difference from Ventus is the timeline. While Ventus pays daily, Indemo investments typically mature in 18 to 24 months, delivering substantial lump sum returns. For our non-volatile core, I suggest allocating 20% to Ventus Energy for daily distributions at around 20% yield and 20% to Indemo DDIs for substantial 15 to 17% returns over 18 to 24 months. Let me show you what this means in real terms. On a $100,000 portfolio, your $40,000 allocation to these non-volatile high-yield instruments would generate approximately $7,600 to $8,000 in annual income, $633 monthly, $146 weekly, with Ventus portion paying you daily. This gives us a foundation generating a 17–20% yield just from non-volatile portion, already more than most traditional investors see from their entire portfolios. But now, let's add our next layer. Now that we have our non-volatile foundation generating exceptional daily income, let's add our second layer. Moderate yield income enhancers making up to 20% of our portfolio. This segment serves multiple purposes, adding diversification across different income-generating sectors, providing monthly distributions to complete our daily income, exposing us to potential capital appreciations while maintaining solid yields. Here's where we can incorporate business development companies, BDCs, real estate investment trusts, REITs, and covered call ETFs. For BDCs, look at proven performers like Main Street Capital. With a yield around 5.56%, it offers monthly distributions, special dividends twice a year, a history of maintaining payments even during crisis. Notice how Main kept paying dividends even during the 2020 COVID crash, while also delivering capital appreciation of 25 to 30%. This gives us both income and growth potential. Next, let's add covered call ETFs like Global X Nasdaq 100 Covered Call ETF, QLD. With a yield around 10 to 12%, it provides monthly income, exposure to major tech companies, premium generation that actually increases during volatility. The beauty of QLD is that it tends to perform best in sideways markets. When stocks are going nowhere, QLD keeps collecting those option premiums and distributing them to shareholders. Finally, let's add some quality REITs like Realty Income or Digital Realty Trust, yielding 4 to 6% with monthly distributions and exposure to growing real estate sectors. For our moderate yield layer, I suggest 8% to quality BDCs like Main, 6% to covered call ETFs like QLD or JP or JPQ, 6% to high quality REITs. This layer adds diversification while generating around 7 to 9% yield. It complements our non-volatile core perfectly by adding exposure to different market sectors and income strategies. Now we are moving into truly psycho territory with our option strategy Yield Accelerators. These make up 30% of our portfolio and can potentially generate yields that most investors wouldn't believe possible. This segment focuses on sophisticated option-based products that harvest premium income from market volatility. Unlike our non-volatile core, these investments do experience price fluctuations, but they compensate us with potentially massive yields. Let's start with Income Shares QQQI, their Nasdaq 100 0DTE option ETP. Looking at their actual platform right here, you can see this product is delivering an absolutely mind-blowing 94.25% distribution yield. That's not at typo 94%. This product uses sophisticated zero DTE, 0 days to expiration option strategy in the Nasdaq 100 index to generate these exceptional returns. Next to it, we see SPYI, their S&P 500 zero DTE options ETP, generating a 69% yield using the same strategy but on the S&P 500 index. These yields make traditional dividend investing look absolutely prehistoric. While everyone else is celebrating their 3 to 4% yields, these option-based ETPs are generating returns that can potentially change your financial life. Then we have ProShares Bitcoin Strategy ETF, BITO. This beauty can generate yields up to 40 to 50% through its future strategy while giving us exposure to Bitcoin. What makes BITO special isn't just the yield, it's how that yield is generated. By capturing the contango in Bitcoin future markets, BITO provides a way to potentially profit from Bitcoin structural market dynamics regardless of whether the price moves up or down. With our 30% allocation to this segment, I suggest a strategic allocation of 15% to BITO for Bitcoin futures exposure, with 40 to 50% potential yield, 7.5% to QQQI for potentially 94% yield on Nasdaq 100 option strategies, and 7.5% to SPYI for potentially 69% yield on S&P 500 option strategies. This creates an extraordinarily powerful yield acceleration layer that harnesses market volatility to generate substantial income. The 30% allocation to these strategies gives us tremendous income-generating power that complements our non-volatile core perfectly. Finally, we've reached the rocket fuel of our portfolio, the leveraged growth engine making up 10% of our allocation. Unlike the previous segments that focus primarily on income, this layer is designed for explosive growth over time. This is where we're positioning ourselves for potential multi-bagger returns over a 5-10 year period. For this segment, we are focusing on just one powerful leveraged ETF, QQQ3, 3x leveraged Nasdaq 100 for European investors. While there are several options available in this space including CL2, TSL3, 3USL, we are allocating the full 10% to QQQ3 for maximum tech sector exposure with triple leverage. 10,000 invested in QQQ3 with proper entry timing could have theoretically turned into nearly 1 million over a 15-year period. That's a 41.91% compound annual growth rate, with the best year seeing around 200% return. But here is the critical part. Leveraged ETFs experience significant volatility. During market crashes, these positions can drop 50 to 70, even 90%. This is exactly why we structured the rest of our portfolio to generate substantial income. It gives us the psychological strength to hold to this leveraged position through volatility. By limiting our leveraged exposure to just 10% of the portfolio and focusing on the tech-heavy Nasdaq with its long-term growth potential, we're creating a powerful growth engine while keeping risk contained. This is more conservative 10% allocation, down from the traditional 20%, allows us to increase our income-generating option strategies while still maintaining exposure to potential explosive growth. Now let's talk about managing risk and rebalancing in this portfolio structure. Because make no mistake, this approach requires disciplined management to maximize returns while controlling risk. First and foremost, position sizing is everything. The entire 40-20-30-10 cycle blueprint falls apart if you start over-allocating to the high volatility portions. The percentages I've shown aren't arbitrary. They are carefully designed to balance income, growth, and risk. Second, yearly rebalancing is crucial. This serves multiple purposes. It naturally forces you to sell high and buy low, it maintains your risk parameters, it prevents any single segment from dominating your portfolio, and so on. Let me walk you through a rebalancing scenario. Imagine after a year your leveraged ETFs have performed incredibly well and now make up 15% of your portfolio instead of the targeted 10. During rebalancing, you would sell enough of your leveraged positions to bring them back to 10%, redistribute those funds to maintain your 40-20-30-10 allocation. And this disciplined approach ensures you are taking profits from segments that have outperformed while maintaining your overall portfolio structure. Third, entry points matter enormously, especially for the leveraged growth engines. The best time to add to these positions is during major market corrections when everyone else is panic selling. Finally, the non-volatile high-yield core is your psychological anchor. Those daily distributions hitting your account provide both financial and emotional support during volatile periods, giving you the strength to hold your growth position through market turbulence. Let me show you the power of 40-20-30-10 Psycho Blueprint in action. With the allocation we've discussed, a beginning investor could potentially build a portfolio that generates 19.72% yield from Ventus Energy with daily distributions, adds 15 to 17% returns from Indemo's discounted debt investments over 18 to 24 months, captures 7 to 9% yield from traditional income enhancers, harvests extraordinary yields from option accelerators from QQQY, SPYI, and BITO, positions for potential exponential growth from the QQQ3 leveraged ETF. Think about what that means in real numbers. On a 100,000 portfolio, 20,000 in Ventus Energy generates around 4,000 annually with daily payments. 20,000 in Indemo DDIs generates 3.2 to 3.4 thousand over the investment period. 20,000 in moderate yield positioning adding 1.6 annually, 15,000 in beta potentially generating 6 to 7.5 thousand annually, QQQI potentially adding another 7,000, and 7.5 thousand in SPOI potentially yielding another 5,000 annually. 10,000 positioned in QQQ3 for long-term leveraged growth. That's potentially 27 to 28,000 in annual income while still maintaining 10% allocation to growth engines for long-term wealth building. But here's the beautiful part. You don't need 100,000 to start. This strategy is completely scalable. Let me show you what this looks like for a beginner with just 5,000 to invest. 1,000 in Ventus Energy generating around 200 annually with daily payments. 1,000 in Indemo DDIs generating 160-170 over the investment period. 1,000 in moderate yield positions adding another around 80 annually. 750 in beta potentially generating 300 to 375 annually. 375 in QQQI potentially adding 353 annually. And 375 in SPOI potentially yielding 260 annually. 500 positions in QQQ3 for long-term leveraged growth. That's 1.3–1.4 thousand in potential annual income from just 5,000 initial investment. What could you do with an extra $100 every month? And remember, as you reinvest these returns, your income grows exponentially over time. This is why the 40-20-30-10 structure is so powerful. By allocating 30% to these option strategy products with their extraordinary yields, we are creating an income machine that can potentially generate returns that most traditional investors wouldn't believe possible. But this isn't just about today's income. This is about engineering a complete wealth-building machine that gives you daily income, substantial returns from your long-term investments, monthly distributions from your yield enhancers, extraordinary yield from your option accelerators, exponential growth potential from your QQQ3 position, all tied together with yearly rebalancing. The beauty of this approach is that it's designed for every type of investor, from beginners with just $5,000 to sophisticated investors with six-figure portfolios. The framework is infinitely customizable while maintaining the core principles. If you are ready to take your investing to the next level with strategies most financial advisors are too afraid to even discuss, smash that subscribe button and hit the notification bell. Remember, while others are settling for mediocre returns, we are building wealth machines designed to potentially generate serious cash flow today while positioning for explosive growth tomorrow. Because sometimes the craziest thing you can do is play it too safe. This is Psycho Investor, and I'll see you in the next video.